Okay, let's go ahead and get started on chapter 1 handout. This is a handout that goes right along with the chapter. And it's just kind of an outline and basically the important points of the chapter. Okay, what is fraud? Fraud is a representation. So it is when you tell something that is in this case, a material point. So this representation could be orally or it could be written. That is false. Usually intentionally. It's believed by the victim and acted upon by the victim. Hey, I didn't highlight. There we go. And acted upon to the victim's damage. Okay, so this is what fraud is. The usual definition of it. Types of fraud. Employee embezzlement. Notice you're taking the CPA exam. This is the type 2 fraud with the hilarious hilarious term misappropriation of assets. So that's employees taking assets. But this is when employees steal from their employers. So some examples: an employee takes cash from the cash register. A very common one is employee submits non-business receipts on expense report to be reimbursement. So for instance, I go on vacation with my family and I submit those expenses as if they are for the company. So, so like vacation expenses, something has nothing to do with the company. Or an employee takes the customer's checks from the mailroom. When the customer mails in their checks, the employee takes them and deposits them in their own account or cashes them. So this is a type 2 fraud by the ACCT471. Management fraud. This is usually done by people higher up in management. Top management is usually involved in this. So what are some of the examples of this? And by the way, this is what CPA firms look for. Basically, they're looking for management fraud. It's possible you have type 2 fraud, but it would be very unusual to get enough of the type 2 fraud to sway the financial statement, especially on a larger company. And again, this is typically what the CPA firm is looking for when they do an audit. So CPA firms are looking for management fraud usually. And a couple examples, 3 examples. A lot of times they're to increase net income. So the first couple here, how do you increase your income? You have fictitious sales, or you say that your expenses are lower than they really are. Now, it is possible, though, that the fraud's kind of going in a different way. And especially for smaller companies, a lot of times they're trying to understate their income because they want to pay less taxes. So it could go the other way. Sometimes they're trying to make financial statements look better. Sometimes they're trying to make them look worse. Okay. Investment scams. They usually come about by selling worthless or fraudulent investments, are sold to unsuspecting investors. And you would think that this would be less common nowadays, but it actually is still there. Vendor fraud. Okay, so these are people that sell, vendors are people that sell goods to the company. All right, so vendor fraud, it comes about, it can be two different ways. One, by the fraud perpetrated by vendors acting alone, so that they're just doing this to the company by themselves. Another way is through collusion with buyers and vendors. So these are things like kickbacks. And let's spell kickbacks correctly. Okay. And usually it comes in three different forms. Overcharge, send inferior goods, or don't ship anything at all. And notice that they're getting checks sent to them for this. So this is actually cash coming out. Customer fraud is fraud that happens when a customer deceives the company. Okay. Very important point. Criminal law versus civil law. Criminal law is when you have an offense that is against the public. So these are cases where you go to jail, can anyways. So it's a crime. Oops, let's get the right highlight there. So you can go to jail for these, pay a fine. They have a jury, 12 people. The jury's decision must be unanimous. And the decision, this is very important, must be beyond a reasonable doubt. As a business, if you find evidence of fraud, you can take that evidence, turn it over to law enforcement, and law enforcement will usually make the decision whether to pursue this as a criminal, or it's possible they don't think there is enough evidence and they won't pursue it at all. So it is possible that even though you have this evidence, that it may not be good enough or may have been collected in a certain way that is not allowed in court. Okay, civil law. So let's say that you turn this over to law enforcement, and they may or may not take the case. Civil law is when you try to recoup any damages. Now, civil law, these are only for compensation. You don't go to jail on a civil lawsuit. Jury 6 people, judges often hear the cases instead of juries. Another thing is, if it is a jury, the jury does not have to be unanimous. If there is a jury, the decision does not have to be unanimous. All right, now another very important part of this is that it does not have to be beyond a reasonable doubt. This is only a preponderance of evidence, generally over 50%. So the evidence needed is much less on a civil trial. So the evidence needed is less than a criminal trial. Because of this. You need a lot of evidence to have a decision beyond reasonable doubt. Less evidence, still needs some evidence, but less evidence for get over 50%. And a business sues the fraud perpetrator for compensation. This is not for punishment, it's for compensation. Okay. An important note about fraud. And the fraud examiner never accused somebody of a crime they've never been convicted of. So you don't say that this person is embezzling money. Embezzlement is a crime. And until they're convicted in criminal court, you can be sued for that. Falsely accusing someone of a crime is slander or libel. And yeah, they can sue you. Every now and then you hear someone talk about, this guy embezzled money from the company and, they fired him. He turned around and sued the company he won. Yeah, probably because they accused him of a crime that he wasn't convicted of in court. In civil court, you cannot convict somebody of a crime. This is a civil court. Slander is a civil court. It's for compensation. So you say, well, I'll bring the evidence and I'll prove that this person did this in a civil court. You can't have a crime verdict in a civil court. So if you accuse somebody of this and they haven't been convicted of a criminal offense, they can sue you down here, and you cannot prove criminal in a civil lawsuit. Okay. Coming down here. Auditing versus fraud examination. External auditors. Oops. External auditors are required to look for fraud. Part of the standards that they must look for fraud. However, they're only looking for material misstatements. Have that capitalized. But they're only looking for material misstatements. For example, Walmart is a multi-billion-dollar company, so a $5 million misstatement, $5 million misstatement would definitely not be material. This would be immaterial to Walmart. So let's get back to the fraud. When their external auditors are investigating, they're not looking for something as small as a $5 million fraud. And many businesses wrongly assume that they are. They think that they are looking for all fraud. They're not. They're only looking for material fraud. So it's very unlikely for external auditors to find fraud, because it has to be to such an extent that it shows up on the financial statements as material. So external auditors do not find fraud. It's a one of those it's a gap in what people think the external auditors do. They're only looking for very large things that will sway the company. Now, it could be a smaller firm. Of a smaller firm, obviously, $5 million is a huge amount of money. Then, yeah, they'd be looking for it. But especially for larger firms, they're not looking for fraud unless it's material. So, if someone's stealing $50,000, a lot of companies, that's not going to be material. Internal auditors who work inside a company. So Walmart, for instance, has their internal auditors, and they will conduct investigations into much smaller amounts of fraud. So the internal auditors are usually much more likely to find fraud. Because they're looking for smaller amounts. $5,000 fraud. And the fraud's gonna be much smaller. External fraud examiners are fraud examiners that we brought into business to investigate fraud. So it is possible, especially if you find out that there is a fraud, you might bring someone in from the outside, just because it will be possibly easier to do it with people from the outside than people on the inside. Especially if you don't know exactly who's involved in the fraud. Okay, so external auditors, CPA firms usually not, they don't usually find fraud. Internal auditor is much more likely. And I'll put this here. Most fraud is identified by employees of the business. And we're going to get into, if someone's creating a fraud, is that they oftentimes will, their lifestyle changes may not be apparent to, any of these people. They didn't know them. So if all of a sudden Tom is driving a new car, it's that is way beyond his means, Ferrari or something, it's not going to be apparent to the external auditors, probably the internal auditors or the external party examiners. They don't know his background, and that whether that's an unusual thing for him to have or not. So a lot of times this is, other employees will say, wait, why is, how does Tom have all this money all of a sudden? Okay. Sales necessary to recover employee theft. Now, this is sales versus income. So theft results in a 1-1 loss of income for the business, not sales. It's going to take more sales to make up for that loss. Okay, so here we have the Happy Place restaurant. Employee steals $50 in cash from the cash register. Given the following information, what amount of sales would it take to make up for the theft? Okay, first thing you have to do is find the ratio of income to sales. So income divided by sales. So 5,000 divided by 20,000 is 0.25. The next thing is to take the theft and divide it by our ratio here. Okay, so theft of $50 divided by 0.25 equals $200. Let me use my calculator here for a second. 50 divided by 0.25. $200. Sorry about that. So this is what the sales would be required to make up for that $50. So the sales required to make up for that $50 would be so to make up for that $50 theft, it would take $200. So it depends on how much their income is relative to their sales, as far as what we're looking for here. This would be, if you look for a ratio, this would be like return on sales, something like that. Okay. And it can change depending on their, oops. their return on sales. So for instance, down here, income of 10,000. Sales of 100,000. Get a little longer. So this would be 10%. So the same $50 sale down here would require $500. So even though it's the same $50, it depends on how much, what the return on sales are. So a $50 sale would mean you have to sell $500 worth of stuff to make up for it. For example, two. And I should probably insert something here. Okay. Yeah, that is it for chapter 4. No, that's chapter 4, chapter 1. Okay. Go down here one more time. Zoom out here. Oops, that far. So the amount of sales required can change based on what the return on sales is. Okay. And chapter 1 handout.